Keep hands.
Hello, this is Gabe Padva with Evolve Investment Group, investwithevolve.com. Today, I'm here with Peter Kinch from the Peter Kinch Mortgage Team. I'm very happy to have you here. And Peter, I just was hoping that you could tell the audience a little bit more about your thoughts on the current mortgage economy.
Yeah, well, I think, Gabe, the biggest thing that's on people's minds today is where interest rates are going. And there's two different things. One, when we're talking about the mortgage economy, we're talking about rates and where they're going. The other one is, if you're a real estate investor, how am I going to get mortgages? And that's a totally different topic. With terms of rates, let's talk about where they're going. We know the Bank of Canada has already come out and said that they're not going to change rates between now and June of 2010. When they're talking about the Bank of Canada comes out and talks about rates, they're talking about the prime rate. That's your floating or your variable rate. So we know with a great degree of certainty that the variable rate will not change for the next year. However, that doesn't mean that your long-term rates are going to be doing the same thing. Long-term rates are governed by the bond market, the bond yields. The bond yields can actually move in anticipation of an event. And the event that they're anticipating right now is what I call the Obama factor. And the Obama factor is the spending of trillions of dollars and going to multiple trillions of dollars of deficit in the United States. The real question is, what will be the fallout? What will be the economic hangover after we wake up with a multiple trillion-dollar deficit a few years from now? What inflationary factors are going to kick in? We know there's an inflation to follow that. The trillion-dollar deficit is a band-aid that helps create stimulation today, but the fallout has to be inflation. When inflation comes, rates have to go up to combat inflation. So in the next 2 to 3 years, I'm predicting a 3% increase in rates, both in the long term and the short term. And what's going to be interesting after that, I don't expect them to go up into double digits, and I'll tell you why. As the Americans have a $1 trillion deficit, they'll look to devalue their own currency to pay off that deficit in deflated US dollars, which will, on the flip side, cause the Canadian currency to rise. And when you see the Canadian dollar go over par compared to the US greenback, that's going to cause the Bank of Canada to start lowering rates to keep the dollar in check. So they're going to be fighting between raising rates to combat inflation, lowering rates to combat high Canadian dollar.
Perfect. So Peter, would you say that this is a crisis or an opportunity? Will people take advantage of this, or should they just stop investing?
No, absolutely. It's an opportunity because you've got emergency interest rates. Whenever you have an environment where there's emergency interest rates, you're talking about a historically low interest rate environment. You're also talking about a global recession that's caused a softening in pricing. It's not going to last. Inflation is going to cause prices to go up and rates will go up. So we know that we're going to have higher rates and higher prices in the future, whether that future is 2 years from now or 3 years or 5 years from now. I strongly believe people who are 5 years from now are going to look back and say, I wish I would have bought something in January of 2009. Absolutely.
And how would you say investors can protect themselves at this point?
Well, investors can either sit there and say, I'll take advantage of the low interest rates today and float with it, or if they have any concern whatsoever, you can get long-term 10-year money at hovering around 5.5% interest rate. That might look very attractive 5, 6, 7, 8 years from now. So if you have any concerns at all, you can lock in today and be very comfortable with your long-term investments.
Great. Thank you, Peter.
Hey, my pleasure.